Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel, Incorporated. Welcome back to the show.
Thanks, Jim. Happy August.
The Fed has lowered its interest rate by 0.25%. The Bank of England is staying pat at 0.75%. Canada didn't change its rate the last time it was adjusted. But will we see Canada and Britain stay pat?
No, I don't think so. I think that Canada will inevitably have to follow. Britain too. There's very similar themes at work here. And they are a global dependence on exports, which are under threat. And you see today the Chinese-U.S. negotiations are stumbling again, and the Trump government has announced that they'll go ahead with another 10% in tariffs starting in September. The issues at hand here are not easy to fix, right? This is a systemic method of accessing technology in exchange for them manufacturing goods. And so this is not something that's going to be easily resolved. And so every time we get a optimistic headline, you see stocks rally, and then when the reality hits that this is going to be a long time in negotiations and ongoing escalation of tension, you get a further pessimism about exports because we've already got a slowing economy worldwide. So on top of that, you have this aging demographic, which certainly in the UK and Canada, the baby boomers, their natural inclination towards less consumption, wanting to downsize, those factors we've discussed many times. On top of that, you have the debt bulge, which is slowing consumption naturally all over the world. And again, we are already, 37 years of cutting rates from what started out as very high, abnormally high, in 1980, when interest rates peaked and Volcker, was squeezing inflation out of the system. We were 4 times the norm since the 1700s. I mean, we were at an extraordinarily high level of interest rates. And then for 37 years, they were able to sort of use that as the wind at their back as central banks stepped in and cut rates each time the economy slowed. And that worked, for a long time. But it came to this inevitable endgame where we are now, which is a world, massively indebted and interest rates already at an extremely low level. Even though they would like to re-stimulate consumption and more debt accumulation, at some point people are just toxic with the debt they have. And certainly in places like Canada, that's the case, right? We have record low savings rates and record high home prices, as you know, actually world famously high home prices in terms of price to income and price to rent. We're the most unaffordable in the world relative to other countries, along with New Zealand. So we've already sort of, like I said, we were on this downward slope when you're starting from really high rates, and we had relatively higher tax rates in the early 80s. They start cutting that. They do it for 37 years, and you get to the point where the debt is crippling. The demographic is that much older. Consumption is naturally slowing. Birth rates are naturally slowing. So you've got a deflationary impact coming. And although central banks are nervous and worried for sure because they're used to having much more to work with in terms of cut room, they are, facing this massive downturn in the global economy and all the metrics that we look at. Germany's PMI manufacturing has been contracting. They're the powerhouse economy of the European Union. You have, weakness all over the place. Asia, Hong Kong, South Korea. All these economies are in a free fall state right now, and then you get this escalation in the trade stuff. So I think that they're going to have to try and cut rates. It's not going to have much of an effect, and we've really got to come up with new innovative ideas on how to rebuild the economy. And that's particularly the case in Canada, where we've had this really unhealthy reliance on these two cylinders, which was housing, which is ultimately unproductive. Beyond having a shelter, bigger and bigger and more indebted houses are counterproductive, and that's where we are with Canada. And of course our dependence on fossil fuels, which are becoming very unpopular as an investment theme around the world. There's the Mark Carney at the head of the Bank of England just did a report in the last couple of months warning that the impact to the global financial system is significant as the world moves towards decarbonization, and that banks are heavily exposed because of their lending. So this all goes with, in spades in Canada, where we've really been in a state of denial for the last decade for sure, where the writing's been on the wall that the world is wanting to move into, the next iteration of energy, renewables, different food types, into plant-based eating, all these things that are new energy systems for humans and for our machines and everything that we use to run the world. And Canada's really been hoping that it wasn't happening, but it is happening, right? And there was another article that I had on the blog this week about the fact that major investment companies like BlackRock, for example, which runs ETFs in the world, it's got some $6 trillion in money in its relative funds, is coming under a lot of pressure from investors, institutions all over the world who are pointing to things like the Bank of England's recent study about risk to the economy and the financial system due to fossil fuels, and saying, we need to divest, we need to reduce our exposure to this sector. And so they're having to, you're just seeing funds flow out of the fossil fuel sector. So that is bad for Canada because we haven't prepared properly. There's lots of opportunity, but it's going to be a lot more complex and time intensive than just cutting rates and driving more consumers to the mall.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, you were mentioning lower demand for oil. Why is that?
Well, first of all, because we have the cyclical reason is that the economy is in a massive downturn globally, right? And if this is the next recession, which seems like is very likely, certainly it's been long overdue here, a decade since the last one, you see we have a lot of supply sloshing around the world. We have much more supply from various sources because of the technology that has enabled ramp up in production, certainly all over, but in America and various other places. So we've already had this huge ramp in supply and capacity over the past decade. At the same time, we have this a lot of innovation in terms of efficiency. Countries like North America, where we're notoriously high energy consumers, are even showing, a reduction because of efficiency measures, because people are consuming less, because of the aging demographic, because there's this theme of how to downsize your overhead and expenses. All these things are pointing towards lower demand and lower consumption in these aging populations, which have traditionally been the highest consumers. So yes, we have developing countries coming into fossil fuels, their economies using them, but again, the rate at which they're using them per capita is nothing like the rate at which we've been using them in these developed economies. So that theme is going on. That's a much more secular theme, right? So the global economy downturn, recession, it may last a year or two, and that's a cyclical reason that you'll see a downturn in oil prices. And I think, this stuff about the tariffs and why the stocks and oil is down over 6% today, again, being hit by those cyclical factors. But the secular factors are more persistent and long-living, and they are things like the transition away from traditional energy sources, so renewables, the movement to electric vehicles. Not only that, but this movement away from plastics is also a major reason why, the IEA has estimated that just the reduction in plastics that's underway in the world, which is essential, right? We can't continue to pump out non-biodegradable packaging and plastics all over the world because we're literally drowning the planet in it. And more people have caught on to that in the last year or so as they've realized that China, it wasn't really until China stopped accepting our waste that it started backing up in all over the place in the developed economies. And now people are aware that most of what we collect or put into blue bins is ultimately not recycled. And so there is bans coming, it's slow as molasses. It started with straws. This week Sobeys announced it's going to be phasing out plastic bags by January of 20. I mean, this is all just at the edges, incremental stuff, but we're going to see a lot more banning and a lot more insistence on alternatives, and that's good because there's lots of opportunity there for investment in business to come up with solutions. But that does mean, like the IEA predicts, that just the reduction in plastics could be a 20% hit to the oil demand that was previously estimated, and that could be even more than the hit to electric because of electric cars, so which they estimated to be something like 20% reduction in demand between now and 2040. So these 20s and 20s add up to a lot in terms of lower demand for the stuff, just as supply is swamping the planet. So I think the themes at large are definitely towards organic food. Another reason why a lot of petrochemicals go into fertilizers and things, which are already becoming phased out in farming in various places where they've decided that they're not the healthiest way to produce food. Plant-based eating, which is more about eating the plants instead of feeding the plants to the animals, and just animal agriculture becoming less prevalent in a world with moving to 8 billion people. So all these factors are insisting on greater efficiency and less waste and less pollution, and most of them therefore weigh against the addiction that the world has had to fossil fuels in the last number of decades.
We'll have more with Danielle Park right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, the U.S. administration is looking at legislation that would allow mass purchases of Canadian pharmaceuticals. Is that going to lead to even more drug shortages in Canada?
Well, yeah, I mean, it could. We'd certainly need to, it's sort of supply and demand. If you're going to have a ramp up in demand, clearly you would have to have more product. And again, there's investment opportunity here. If, right now, Canada wants a world that needs something that it has to sell. So if there's a growth area in pharmaceuticals as an area where we can ramp up investment and production, certainly that might be one area to help the overall economy. There's something, it's another thing about the American healthcare system, sick care system, as I like to call it. It is also unsustainable. The expenses that have been, pushed through because we've had a lot of funding and HMO and drug companies and things that were elevating prices have now sort of, defeated themselves because the population can't afford to consume it. And, it's inevitable, I think, in this next election cycle that these issues will come back into the public view and that more pressure will increase, especially if the economy continues to deteriorate between now and the U.S. election. I think these hot issues, about how people, if we've already got, how do we get less debt out of the system? How do we get a slash in the outstanding student debt? How do we make shelter prices more affordable? How do we get increased wages? How do we make sick care more affordable? How do we get people access to drugs? These are the real tipping points that come when you've had an economy that has become so highly polarized between, a tiny fraction of the population with more money than it knows what to do with, frankly, and not even aware of the extreme escalation in some of these basic costs of living, and then the vast majority of the population who are struggling to make ends meet. And so the tipping point or the correction that has to come there has to do with how do we make life more affordable for the masses. So that will partly be a function of how do we get increased income into their pockets in various different ways. But also, I continually talk about this because I think it is so essential to the healing of this mess, is how do we get the cost of living down so that, health and well-being are more affordable for the masses, so they don't have to go into more and more debt just to afford basic necessities. And, those are the ideas which are going to be in high demand and very popular.
Are pension plans too optimistic about the kind of returns they can expect in the future?
Well, absolutely. So this goes back to, again, 37 years of cutting rates, increasing debt in the system, driving up asset prices to compensate for the loss of wage growth. Those have had these other knockoff effects, which is that we started from a period where, for one thing, if you look back to 1987, most pension funds in the early 80s were holding the bulk of their assets in the lowest risk bonds, for example, government bonds. And in those days, you could have a government bond that was paying you 9%, for example. So you could have 70 or 80% of a pension fund in government treasuries, which were considered very low risk, very little chance of disappointment in terms of hitting your return target, collecting 9%. And then at the other end of that, you had stocks which had come off a 17-year secular bear market where they started in 1966 from very high valuations, not nearly as high as today, but something like today. And they fell significantly all the way through to 1982, where you had the opposite. You had extraordinary value inequities. So not only were bonds yielding about 9%, but you had the part you wanted to put into equities was starting from single-digit valuations, so extraordinarily attractive value, as well as dividend yields that were north of 8%. So on a portfolio of invested money back in the early 80s, pensions and other people could have a realistic expectation of making 8% a year on a gross basis, before fees or that sort of thing, but making that sort of target. What happened was, as asset prices rose and rates came down, people didn't want to adjust their return expectation. And certainly no one wanted to increase contributions, which was the obvious thing one should do. If your estimated rate of return is coming down year over year, you should increase your contributions, or you should reduce your planned withdrawals, or you should, defer the age at which you're going to start withdrawing, cut expenses and overhead. All those things were what you should do to continually meet your payout obligations or your target for what you wanted to pay out. But instead, people didn't want to do that, and so they said to asset managers or pensions, hey, let's just increase risk. Let's increase the amount of money that's in the gambling category in the hopes that we can outgun this thing. And that went on for, the last, since the early 80s. But when we hit high valuations in 2000, we were then at the point where we had been in 1966 in terms of investment returns looking forward in the equity class were dismal. And at the same time, interest rates on treasuries were around 6% in 2000. So you could still then hold some government bonds, but, the prospects for the equity side were not good. And indeed, that's been the case, even with this remarkable run in the last few years where QEs of the world came in to, force up the price of stocks. Their long-term return since 2000 has been, like about 4%, and that's assuming you didn't take out any withdrawals or pay any fees, right? And so in real life, of course, that's not what happens. In real life, people hit retirement age and start taking money out, which means you're losing the compound reinvestment return potential on the funds that are being extracted, both for fees and for income withdrawals. And so now the return prospects, even if you're fully invested today in a 50-50 or a 40-60, whatever the mix, or, some pensions, as we've discussed before, are now like 80% in highly illiquid, high risk sort of category, relative to, the opposite they were in the 80s where they were all mostly guaranteed. And so now they've got, even with this really high risk exposure, because they've managed it improperly and deferred all the hard decisions and kept hoping for fairies to come to the rescue in the form of central bankers. What's happened is that now the return prospects looking forward are, maybe 3.6%, something like that. And many studies have pointed this out, that, hey, best case scenario going forward is that you might make, just under 4% growth. And of course, these plans are still factoring it in at a 7.4% expected return. And unless they hit that 7.4%, they will not have nearly enough funds to meet the obligations. But even with those rules of thumb, a high percentage of pension plans today are, 70% funded. Not, 30% of the money required is not even in the kitty, and that's if they assume these unrealistic return numbers. So there's a lot of hard decisions coming. There's a lot of reality checks that are going to hit, and then people will have to do the hard decisions of let's, defer the age of that we start these withdrawals. Let's increase contributions. They're going to have to figure out ways to revamp financial decisions and plans all around. But for others who have not taken that bait and not taken on excessive risk and not bought into unreasonable asset prices on the hopes they could outrun, a reasonable return target and somehow magically fix this, for the people that have done the right things, which is use low rates to pay down debt, build up their savings, keep it liquid, keep it safe, not, take the bait and go into the very aggressive and high risk classes of securities, they still have a very good opportunity over the next decade to outperform return expectations because they have low expectations at the start. So those that have been sort of just keeping their powder dry and not going into risky stuff and don't lose a ton in the next drawdown phase, which the world is heading towards, will then have the opportunity to put that capital to work at something like we saw in 1982, at least on the equity side. So perhaps interest rates are going to be, low for a considerable period here as the world grinds through deflationary impacts of demographics and debt and innovation, technology, all these things that are keeping, interest rates low, we may indeed find that the corporate debt side will reprice significantly in this coming downturn. We've got the most corporate debt ever in the world. There's been a 400% increase in the triple B category, which just barely above junk. And as soon as we get into financial strife, companies routinely get their credit rating knocked down a branch. And once that happens, a lot of pensions and institutions that are holding this debt is going to have to liquidate it because they're not allowed to hold it, in which case you'll see corporate debt reprice, and there will be an opportunity there where you'll be able to pick it up at, a significant discount to current prices on that security, and your yields will be much higher. At the same time, equities are likely to reprice significantly, and you'll be able to pick up equities again on an investment thesis with a dividend yield perhaps north of 6%. So there's great opportunity coming in this perfect storm that is now, circling the globe. But you have to be very cognizant of why and what is happening and how to position yourself. Like, for example, government bonds have been an area that we have had in our accounts for the last couple of years as a strategic decision away from the corporate debt sector, which was going, extremely toxic in all the levels that we've been measuring it. And indeed, what you're seeing right now is that other investors around the world are leaving places like Europe and other markets which have, something like $14 trillion now in negative yielding bonds, and they're attracted to where? To Canadian municipal and provincial debt, because we still have a positive yield here. So as those flows come into government bonds, those people holding them in Canada get a capital gain on top of the income that they're collecting. So that's another way to help sort of diversify in a meaningful way, but also, benefit from these trends as they're unfolding around the world. And then when, the recession unfolds and everyone's panicking and selling their stocks, there's an opportunity then to reallocate funds away from government bonds and into the corporate sector once more.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.